So thank you all for showing up. I'm here to talk to you about Pluranomics. Plura stands for many, or diversity. It's in contrast to the economic system that we have today in capitalism. Capitalism is more based on a monopolistic type system. It tends to grow businesses to be larger. It rewards size from the stock market. Everyone's goal is to get bigger and kind of go IPO and sell to the market. Then the market ends up with this monster-like company. And in my opinion, one, in many cases, at least in the commodity production and distribution world, is much less efficient than it was when it was more naturally sized. If you think of the stock market, think of it as one huge landlord, right? Who's the largest company in the stock market is Walmart. You know, Walmart's business is distribution. They control real estate. They have moved real estate markets from diverse urban downtowns. They've picked up all that urban distribution and they've located it all in one place. But when they locate it all in one place, it creates much less competition, obviously. Walmart is just one big landlord. I have this concept of mini stock markets, and these mini stock markets provide financing for smaller entrepreneurial companies the same way the larger stock markets provide financing for the big boys. And these mini stock markets do the same thing, as they inevitably compete with one another, driving the costs of rent and energy to a more stabilized place or balanced place. The never-ending cycle. Typically it starts with a depressed market. Both real estate and proportionate labor wages are depressed, so people see this opportunity to invest. Today's world, we're probably here, right? Tenants are starting to get kicked out. There's some depressed markets that exist, but these depressed markets have existed. And there's places in Detroit, Cleveland, Connecticut, where I'm from, they've been depressed for a long time. So for people to say we're entering this recession or depressionary period, it's just a lot of news. In my opinion, there's been depressionary markets that have existed for 50, 60, 70 years. You can ride the coast and see them all over the country, and they've just been vacated, basically, or left as ghost towns. So low relative rents allow for tenant growth opportunity, more supply than demand for real estate. And this is when tenants and entrepreneurs see that there's a viable game out there to play, there's profits to be made, and they start coming into these markets. A growing market exists, business tenant occupancy rises, real estate value increases, and inevitably rents rise. And this was the role that I played for 10 years. I was the rent riser. This is the game that we're all somewhat ignorant of. We all just keep playing it and keep playing it until, unfortunately, business tenant profits decline and vacancies increase. Today we've seen a spike in vacancies. They're double digit now, and this is inevitable, the cycle that we have. We're seeing Starbucks close 600 stores, and big and small alike are finding themselves with this cost structure that they can't support, and they're forced to close. 3 years ago when I was writing this book, tenants understood where I was coming from. The landlords, and they were sitting pretty, right? But I think now I could speak to both of them, landlords and tenants alike. I think there's this game that doesn't benefit anyone that we're playing. We can't find this level of balance. That's what we're going to try and do here, is find this balance of rent, and we're going to try and break the cycle. An investor or a landlord is going to try and create spread between the rents that they charge and the tenant's ability to pay those rents. That's what breaking the cycle is after. It's after this rent dividend that's super, super, super stable. And at some point, we're going to learn real estate value increases, landlords opportunistically stabilize rent, creating dividend. Business tenant profits grow, not rent. And this is this idea of that rent balance. And this is what the theory is based on, is this rent balance. And landlord rent dividend security appreciates. A landlord or an investor can find itself realizing appreciation through a super stable rent dividend, and as the tenants make more and more money, in theory, like a bond, would pay off and the bond would appreciate.
How do you factor in inflation when you're talking about the fixed price?
In my opinion, inflation is rooted in rent, energy and rent. It's the reason why inflation is here. So if we're able to to find some rent balance or some kind of stable rent, then inflation should be gone. For instance, if you look at Ann Arbor, if rents were stabilized in the early 90s, that cup of coffee on the corner of State and East Liberty would be half the price it is now.
So who exactly would want to take this initiative?
What I write about in the book is this concept of state pension funds. You know, they're huge players. They're still sending a lot of money and capital out of their state. To me, it's like protect your home turf. Like, why would you do that? I know diversification is key, but stabilizing costs for your own retirees is something that we've just forgot about. How a state pension fund, let's say Calvert, state of California, the pension fund is probably one of the 5 largest funds in the world. Why it wouldn't have a strategy to control costs in its own state? These are the retirees, like, it's their money. Why they're sending money to Massachusetts is beyond me. So that would be a perfect investor for this. So they would go after a strategy in their own state to implement this. I really believe that if an investor of that size and magnitude went after it in their own state, then it would just catch on like wildfire.
The landlord fixed rent idea is more for like a conservative landlord. What if the landlord's not risk averse?
There is not a landlord in this country that is not in trouble, other than the guys that didn't increase their rents to the point where they swallowed the tenants. It could be called conservative, but I view it as more of like 10-year plus holds. We've lost this concept of long-term investing. All the private equity firms, all the corporate pension funds, state pension funds, all the day traders, right? I mean, that's the epitome of it all, of this short-term investing. So when you say risk averse, I mean, I just view it as long-term investing. You're seeing deflation happen at on property prices, right? All property is deflating, all assets are deflating. And you're seeing inflation of electricity essentials, right? This is what happens in tough economic times. Essentials, electricity, food, prices of that are going up, and non-essentials, right, flat screen TVs, cut in half, big houses, cut in half. All this stuff that are not really essential for living is deflating. So when you pick up a paper and the Fed tells you there's no inflation, it's like, yeah, because you're looking at, you know, big houses coming down in price. And that's what skewed the inflationary numbers significantly. When this game takes place, everyone is forced to play it. All landlords and tenants alike are forced to play it. In Ann Arbor, you have 3 retail distribution markets: Liberty and Main, State, and Southview. Rents are $30 a foot per se. I think they're highest here, second highest here, and Main Street's starting to feel some impact. In fact, most of the vacancies occur on Liberty right now. That's what's most hurt. So what happens in this new game is that tenants come in, they demand a few things. One, they demand long-term leases, or they purchase buildings, both, on Liberty. And the other thing they do is they're smart enough to put in renewable energy. They put solar panels on their roof and geothermal systems, so they stabilize that cost for sure. And they negotiate rents, because there's so many vacancies, they negotiate rents down to $15, and they have options for the next 25 years. And other tenants on Southview and State learn of this opportunity to come in on East Liberty and realize these low rents. Tenants flock, right? They see it and they leave Southview, or they leave State, or maybe they'll negotiate with their existing landlords and say, I'm leaving if we don't have this new rent. And consumers are learning about it because the products are cheaper there. They're higher value, right? So the consumers are starting to flock here to purchase their coffee. And the new game takes hold, and this idea of whether it's depreciating rents that continue to fall and fall and fall, or they reach some balance where this guy's playing against this guy, playing against this guy. And inevitably, other markets around it are forced to play. Some of the diners that you see out there, you can't believe they've been there for, what, 30, 40 years. One of the reasons they've been there is because they bought the real estate. They own it. And they haven't allowed the rental increases to occur. 20 years ago, tenants didn't have this information that they have today. They couldn't just cruise around the markets and find out what the rents were, find out what the foot traffic is. And today, there's more of a balance between landlords and tenants.
Thanks for coming.